Good afternoon, everyone. Thank you all for joining us for, what did we end up calling this? How to invest in a sports technology company, something along those lines? That work? Yeah, sure. So we have a fantastic panel of folks here today. I'm Steve Ander. I'm the head of M&A for Pillsbury Winthrop, a law firm that does plenty of investing or helps plenty of folks invest in sports tech companies and helps entrepreneurs too, so give me a call. I'm going to turn the mic over to each of these folks to tell you a little bit about who they are, what organization they're with, and how they think about the investing landscape, which is going to be a quick intro topic that probably each of them could talk for about 40 minutes on, but we'll try to keep it quick so we can get through a lot of topics because it's a lot of interesting content to cover. So.
Hi, everybody. Great to be here. I'm Meredith McFerrin, Managing Partner for Drive by DraftKings. We are a multi-stage sports tech venture fund with majority of our investments really on the early side, so seed-led. We are also thematically based. Sports tech is really all we do. We're focused in 3 verticals, gaming, fandom, and human performance. We've got 21 portfolio companies. We've got a strong relationship with DraftKings, which is why they're in our name, but we are fully independent. So they are part of a larger strategic platform that we have, but we do operate with just a sort of GP-LP model, so we can talk about that a little bit later. We look for great founders that are, just set out to build something really special with what we hope will be sort of unbounded kind of upside opportunity. We stay really close to our founders. We reserve a lot of our fund to follow on, and we work and really love to work with partners like the NBA. We're co-invested in a deal that are both strategic and financial, so good syndicates that can help a company to both access great markets and also have the capital to scale as they grow. So lots more here we can add. Go.
Hi, everybody. My name is Andrew Hibbert. I'm the investment principal with Techstars Sports and Techstars New York City. Techstars is based in Boulder, Colorado. We're sort of the worldwide leader for helping entrepreneurs scale and grow their businesses. We are in 35 cities, 14 countries. We're doing about 600 deals a year, so it's quite a large operation. My focus is on sports tech. So I, along with my partners, run the Sports Accelerator based in Indianapolis, which if you haven't been to Indianapolis, I think it's the best sports town in America. Our LPs are all the major sports properties, including the Colts and Pacers, the Motor Speedway. If anybody's been to the Indy 500, it's the largest spectator event in North America, over 200,000 people. And the state of Indiana through its venture fund as well. So it's very sort of unique private-public structure, our LP structure. We are operating in the pre-seed and seed stage, so we're looking for early-stage entrepreneurs. Really, it's a bet on the founding team, as Meredith talked a little bit about, and I'm sure we'll get into more detail on sort of what we're looking for in founders and in opportunities. And we're mostly the first check into a lot of our companies. I think on average, our companies probably raise about $750,000 to $1 million coming in a program. They have product market fit. They're just trying to really figure out how to get to that next inflection point, really how to scale the business. And it's fun for me because I see a couple of our portfolio companies here, Tiffany, who was on the previous panel, and I know Christy, who I think is coming up next. So that's all I'll say now, and pass it over to this handsome guy to my left.
Thanks, Andrew. Hey, everybody. Thanks for sticking around for one of the final sessions here. I'm Conrad von Moltke. I run Wise Ventures, which is the investment arm of the Wilf family. Their primary business is in the real estate space, and since then they've also layered on a couple sports assets. So owners of Minnesota Vikings in the NFL, as well as the Orlando City FC and Pride men's and women's soccer teams. I run their investment portfolio, so late-stage seed, Series A investments across real estate and then sports media, entertainment. We take all the adjacencies, so we'll do some health and wellness, some longevity, some food and bev as well. seed Series A. And for us, we're trying to be highly strategic capital. So most of the time we have a paid customer relationship with our WISE portfolio companies with one or more of the team assets. And then if we can't get to that stage, then we try to be strategic with introductions. So introductions to other teams, introductions to the leagues that we're involved in, as well as capital raising as our guys scale.
So maybe sticking with you, Conrad, for a second, just to focus on that, and then we'll kind of maybe come back down the line. As you think about an investment and whether or not it's a potential fit, how do you focus on sort of the strategic fit within the broader family portfolio versus the sort of the pure return on capital, growth projections, profitability of the target company?
Yeah, I think for us, we have to have that financial return. That's the first kind of gating item, and that's my role in the first meeting or second meeting. And then I think for us, the strategic rationale comes in that deeper layer of diligence. And a lot of these companies and a lot of your companies that you're building rely on the same go-to-market sales motion with teams and leagues. Could be major league, could be minor league, could be youth. But for us, if I show companies, and we're seeing 500 to 1,000 companies per year, most of which are in the sports space. If I'm showing these companies to the executives at the Vikings and I'm getting a strong signal that they want to use the product, they're excited about it, I have pretty good confidence that when these founders have conversation number 4, conversation number 40 with a team, they're also going to have that same excitement level. So that's probably our second gating item. And then the third is really around the group around the table. So the team, but more importantly, who are the other investors involved and what kind of complementary value can they bring? I think all 4 of us, we can get into this, but we all have very different angles. And it would be really cool for all of us to be on a cap table together because we would all have different networks and different ways to help a company succeed. So that's kind of our internal approach.
Andrew, if you want to take that further from your perspective.
Yeah, sure. Yeah, I think similar to Connor, our LPs, as mentioned, are at the team and league level at the NBA and NFL. So we have the Colts and Pacers that we're always looking at opportunities to invest in products or services that can help them on and off the field, whether it's player performance, player health, ticketing, fan engagement. So I think that's part of it, is getting a sense from our LPs and some of the pain points and the problems that they're experiencing, both from a business perspective and then from a player performance standpoint. And then I think for us, we're really a mentorship-driven program. We have about 250. We call them mentors, but essentially a lot of the folks that you see here on the stage with me would be considered mentors. Investors, VCs, institutional funds, family offices, syndicates, angel groups. Also C-level executives from across the NBA, NFL, Major League Baseball, the professional athletes and celebrities that are doing investing, and then other operators too, founders at companies like FanDuel and Whoop and Overtime. And I think for us, we're trying to find companies that really want to scale and want to raise capital. I think a lot of founders are capital efficient. They bootstrap their business, and that's great. I think for us, we're looking for founders that really want to put their foot on the gas pedal. Our entire curriculum is designed around fundraising, and so getting our founders in front of people that can strategically help them through investing and getting them to that next inflection point is really, I think, the value that we try to bring to our founders. It's a 3-month program, 13-week accelerator. And we try to get them ready by the end of the 3 months, the end of the 13 weeks, to really go out and raise that first institutional round of capital, whether that's at the pre-seed or seed stage.
Great, so I'm so glad I went after you because we like to pick up companies from the Techstars and others that have they're sort of really ready and primed to have a conversation with us around their significant potential in our space. So first thing is we are thematically based. So unlike a generalist venture fund, we are really focused on the strategy of sports tech and entertainment. So we look at the world as like this space that we're in has enormous, super exciting potential, ton of tailwinds, a huge TAM, well over $1 trillion in TAM. So when we are looking at companies, we're sort of zeroing in on a lot of work that we have done beforehand to think about where we believe the high potential is within that strategy, and are the companies that we're talking to in sync kind of with our overall strategy, and then also where we think the growth drivers are. So that's first. And then I sort of think about it as like the T's, right? Like team, supercharged team, passionate, experienced, on fire, can't live without it kind of thing. TAM, can you articulate that within our space there's a market size that's going to generate these outsized returns, tailwinds, areas of growth, right? And then do we have like a 10x plus potential? Here I call it unbounded upside, but at minimum we want to see that kind of return. Our first responsibility, I would say, is our fiduciary responsibility to our investors. So maybe that's kind of where we're a little different than pure strategic capital. But because we have these incredible anchors like DraftKings and other team owners in our fund, we also look at it as very strategic because we've got a lot of access, and we believe around with our portfolio in helping them to accelerate. So we work kind of in this hybrid way where our first look is around the potential, high impact, high returns for both the teams and for our fund. And then how can we partner and leverage all of what we have, both the amazing syndicates that we're able to form and also the strategic LP base that we have to help accelerate the companies that are in our portfolio.
So maybe we'll stick with kind of the intake funnel for all of you about how like the old how a bill becomes a law, if anybody remembers that one. But how a possibility becomes an actual investment. So maybe going back to you, Meredith, what do you like to see when you're talking to these companies? What do you expect to be there sort of before that initial conversation? Otherwise, there's no chance it's going to get through, and then. What's sort of the thing that makes the light bulb go off of, oh, these guys are ones that we want to work with?
Okay, so I already mentioned a number of things that are sort of, I would call them the fundamentals of venture, TAM, tailwinds, team we'll press on a little bit more, but to sort of move to something that perhaps is just a little bit deeper, we are looking for insight. So, what does that mean? It means that we want to speak to teams who think they've got, some kind of secret that nobody else really knows but them. And maybe that's true, and maybe it's not, but we expect that when you're coming for venture into us, you have studied the market, you understand in our space, there's these big movements underway, regulatory movements, technological super cycles, changes in behavior that are quite significant, and we want to understand what you know that is going to break through, create categories, disrupt categories, lead categories. We want teams that have more than just an incremental idea, but something that is differentiated. So insight to the space, it's amazing how many people show up and haven't really talked to the customers that they're suggesting they would serve. So that's nope. But if you have, and you're deep in your space, and you've got something that's sort of we believe the world tomorrow is going to look different than today for these reasons, and oftentimes it's in these intersections, you catch our attention really quick, because that's kind of leading thinking. And then, especially in complicated markets, we also need to be convinced as we further get into a conversation around the ability to execute. Great ideas, great vision, without the execution chops is really, really tough. So we want to see an understanding and appetite for agility and speed and team execution. It depends on where you are in your journey. If you're really early, then we really want to see the insight and then the history around execution. If you're a little farther on your journey, because we are multi-stage, so if we're like in that seed or A round and later, then we start to look at like product market fit or real core differentiation of the product. And then obviously business model. Do you have a sight line to sustainability? Could this business, between revenue generation and achieving these KPIs, sustain itself longer term? And then I guess the other thing is that Tom mentioned too is like, are you talking to us tuned into the environment? It can't be like, oh, and we got a 6 month, we're raising enough cash for 6 months. It's got to be like, okay, we understand. We got to get 18 to 24 months of cash in this kind of market. And so a combination of all those things is really important.
We throw it over to Conrad to go next.
Yeah, I think for founding teams in particular, it's really a question of sales to get from 0 to 1. Right, you're selling early customers and logos, and maybe the terms aren't what you want, but that sales is important. You're selling co-founder, you're selling your initial hires on the executive team that come, and then the selling that everyone talks about, which is the conversations with us, which is selling capital. So I think so much of the early part of building a business is around sales. So I'm looking either for founders who are doing that currently, or who are who have done that in kind of prior situations. And then I think, we've got one company here, Super Sapiens, with Phil over there. I like having founders who have direct experience with the product that they're selling, the various solution. So what is it about your unique lived experience? What is it about your network or something special and kind of different that you have that's going to allow you to have success in the early stage? Because that kind of passion and credibility comes through, and if it's coming through to me, it's going to come through in every call that you have. And I think starting a business is insanely hard, and so to the extent that you can get the credibility question out of the way before you even walked in the door, I think that's just one fewer question that you need to answer. In addition to all the stuff that Meredith talked about with the T's, I might start using that fundamental T's. Yeah.
Andrew?
Benefit of going last is I echo what everybody said.
You can crib off their answers. It's fine.
This can be really quick. At our stage, it's so much of it's about the founding team, as all of these folks mentioned. Unique insight, founder market fit is a term, a phrase that we use a lot. Unique insight or experience or perspective that you have, being obsessed with the problem that you're solving, really understanding how to articulate the problem. I think so many founders, when they're pitching, they're so excited about the solution that they don't spend enough time talking about the problem and why it's a problem and really bringing the problem to life. I think balance is important on a team too. We're very much a CEO-driven program, and so we spend a lot of time coaching the CEOs. And so in order for the company to continue to progress, we can't just stall for 13 weeks. You need a really well-balanced team. So having somebody that can build and having somebody that can sell. It's like having a restaurant without a chef. You need to have someone on the technical side. That's something that we look for as well. I think coachability is big. Somebody that understands that they don't have all the answers, that they can take constructive feedback. We surround our founders, with 150 to 200 of some of the smartest people across the sports, tech, and business landscape, and they get a lot of different perspectives thrown at them, and so it's taking all this information and being able to distill it down and continue to make good decisions. I think really as a CEO, there's three things that you can't outsource. You can't outsource fundraising, you can't outsource hiring, and you can't outsource being able to set the strategic vision for the business. And so, we look for CEOs that really nail all three of those. And then as far as the market, I think, sometimes it's market size. You hear a lot, which obviously is important, but it's also how fast is the market growing that we look for. Timing, I think, is big. And then I think when you're looking at a company, it's, have they been able to do a lot with a little? How capital efficient have they been? How fast are they growing? Is always important. We're not looking for you to have 500K ARR coming into the program, although we've had companies like that. But are you the right team? Is it an interesting market that we think is growing quickly? Do you have a competitive advantage, as Meredith talked about? And are you really coachable? Those are the things that I think we look for in our companies.
So there's a lot of good things here about what will get you through the door, what will get you inside, what will get them interested. Let's talk maybe about what scares them away. Because if you've passed that first stage, if you've gotten that intrigue, if you hit the 3 T's and you seem like you have insight, Meredith, what's going to make you guys stop your investment process? Why does the deal go wrong? And does sometimes the deal go wrong for the wrong reasons and it should have happened, or does usually the deal go wrong for the right reasons?
Usually the deal goes wrong for the right reasons, but there was a time when the deal went wrong, I would say, for the wrong reason from the team. So I'll share an example without naming the team. This was a big no-no. We liked the team. We liked the TAM. They had really good tailwinds. And we could see a 10x from it. The syndicate was good, solid. Partnerships were solid. It wasn't perfect, but we asked for what we always do. The fundamentals, like was it a model, historicals, forecast, balance sheet, all the sort of typical diligence stuff as we start to layer in and check the initial boxes. And we get a forecast with historicals, actuals that were actually not actuals, and late in the process, maybe a few weeks before it was, everyone was about to sign, we, kind of like looking at this and it doesn't make some sense. I think I was the last review on it, and I just, something doesn't add up here. And so, anyway, long story short is CEO didn't really have a good grasp on the financials. Actuals were not accurately reflected, and all explained away, and I actually still think the team's good, liked it a lot, but cannot have that, when we think about execution, confidence, all of that, CEO's got to know those numbers. You cannot export that at an early stage to anybody else. You've got to know it cold. There's got to be financial discipline. Otherwise, all of a sudden, they're like, what? What's going to look like 6 months from now? You start to erode trust. And you can build that back, but not, investors, you and we're a minority passive investor, that's the wrong reason from the team's perspective of just a deal gone wrong. Other times where it is the right reason, sometimes the deal dynamics just aren't right, where the cap table, doesn't set itself up well, in our opinion, for the founding team to actually have significant motivation, and so if it's too small of an ownership position for the founding team, we don't like to see that. If it's a really complicated, messy cap table and needs a lot of cleanup, cap tables matter actually, how you kind of come into the discussion. So sometimes the valuation is just out of whack, and we just can't get to our returns, even though we love the company, and even though we think it's great. Not all companies are set up for venture, or maybe for us, and so that doesn't mean that it's not a fantastic opportunity. It just may not be for us.
Yeah, I would go one step further. This happens weekly, monthly, very, very often. I see the Vikings logo, or founder tells me that they've received a term sheet from this group. It's a very, very small world. So I immediately pick up the phone, hey, XYZ, VC, I was told that you're investing. And they're like, well, we took a meeting 2 weeks ago. I don't know if it's going to go anywhere. Or they did a pitch meeting with the Vikings. That's different than having a customer relationship. and that can lead to legal issues too. So, and also that's a complete no invest for me if you do that. So just be careful.
Yeah, integrity is incredibly important. It's a very very small world. Yeah, I think I agree with what everybody said, and maybe kind of answer the question in two different ways. I think, of course, for us not to do a deal if the cap table's off, if they've given up too much ownership early on, and we don't think that it's going to be a good opportunity for them to scale, and it won't be, we won't be able to present it to a Drive or a Wise venture, then it's not going to be a good fit for us. I think co-founder dynamics can also destroy a company before it even gets off the ground. We've seen that happen a few different times, and it's disappointing because in a lot of cases it's a really interesting concept and an exciting opportunity. I think the other part of the quick maybe answer is where we've seen companies that we have invested in, but where we've seen them struggle from a fundraising perspective. I think so much of it early on is just being a really good storyteller as a CEO, and being able to create a narrative around why you're building this particular company, who you're helping, how you're helping. Early on in our program, we have this concept called language market fit. We do a lot of market fits here, but it's specific language that you're using to address the problem, your customers, and really showing a good understanding of that. I think companies, or I should say CEOs that don't really understand their customers, as Tom was talking a little bit about, can really struggle. I think I've seen CEOs, when they're fundraising, struggle because they fall in love with valuation. And Meredith and I were talking a little bit about this before we got on stage here. I've seen some of our better companies that will go out and start a fundraise and say, we're going to raise 5 on 15. And the first 10 funds they talk to say, yeah, that's too rich for us. We're out. We would have done it at maybe a 10. But so we oftentimes tell our CEOs, don't talk valuation. Don't talk valuation. Let the market dictate that. Just talk about a range and what you're looking to raise, and having a really good understanding of how you're going to put that capital to use. I think so. It's a few different areas where we've seen deals that don't happen, and then when we do deals, when those companies tend to struggle in those areas.
We're getting the sign that we're towards the end, and I want to leave some time for questions. So I'll ask you all for a big takeaway here, which is, what's your biggest prediction? And it can be a wide swing, and it can be a specific thing, but it can't be AI and then nothing more. So what's one big prediction that you had for this sports tech world for the next 12 to 24 months? I'll start with Conrad down there.
No, yeah, cannot be Chad. Anything related to AI or anything like
Chad
that.
NBA.
Yeah, exactly. I'd say I've got two things. One is just increasingly the athlete is going to be a much bigger needle mover than teams or leagues. I think that teams that can plug into their star athletes, like we have one, maybe two on the Vikings, if you can find ways to monetize by using the social following of that star athlete, I think that's going to be kind of a unique differentiator. And then especially with the NFL becoming a lot more international, and how can you make fans who are never going to step foot in the stadium, they're not going to go to training camp or anything like that, how can they feel part of the community from a more authentic way? Still spend their betting dollars, still go to the team store, still watch all the games passionately without actually having any more in-person component.
Yeah, I think a couple things. I think content is really interesting to me and to us. I think we've, I think most Gen Zers aren't watching full games anymore, and so figuring out how to connect with young audiences, whether that's through various streaming platforms or OTT solutions. I think you're seeing a real democratization there of content being king. And I think the other thing I would mention is just on the data analytics side. I think with I know you said not to say it, but I think with the proliferation of artificial intelligence,
You can use AI. I didn't want you to just be like, AI is big. You should look into that.
with the proliferation of AI and machine learning, I think we're seeing a trickle down really at the youth level, in the high school level. There's just this access to so much data that is enabling younger athletes to pick up on trends and to digest various pieces of information that can provide more of a competitive perspective on how to be a better athlete. And so we're seeing that really trickle down on the performance side. So I think like data analytics is and then content, I think are the two areas that we're seeing a lot in.
Okay, so I know I had to really think because I have one for each of our big themes, but I'm going to keep it to one because we only have a few minutes, and I'm going to focus on the human performance space because we're here with all of you. So I am so excited about the say AI, but it is the kind of personal health assistant sort of space where I see a day soon, maybe the next 12 months or 24, where we like get up in the morning and we look in the mirror and based on our metabolic health and all of the biometrics that we have probably being measured about us from the inside out. Maybe it's implantables and it's all the sensors and everything. We lean into that assistant to tell us exactly how to move, what to eat, where to go, when to stand. It's all those things that we already do, but I think linking the content in a deeply personalized way, and I think that's the personalization, right, to kind of land on where it is that we've already come into and I think is deepening across all of our verticals and in the entire space, but specifically in this human performance space, where based on our personalized metabolic and health and even the way we think, our neurological health, we start to also benefit from linked data into these personalized plans, and those plans help us to show up increasingly more often as better and best versions of ourselves. So I see that is on its way, coming soon, and pretty explosive.
Very cool. So we have a couple of minutes left. I'll open it up for questions.
Hey everyone, Anton, co-founder CEO of FanView. So in today's, I guess this is a question for everyone who wants to take it, but in today's competitive VC landscape, how are you guys sourcing deals and identifying startups that have that growth potential?
Quick answers for anyone who wants to go.
We also have a very broad network. We see about 1,000 deals a year, but we really focus on our team not just being inbound, but also being outbound, because we are so thesis driven. We're chasing areas and spaces, so we're connected with, I think, incredible group of co-investors and accelerators and universities. We're also scanning kind of Twitter and buzz around where we think there are influencers and where people are talking about things. So there's a little bit of social sentiment. We're chasing things down as well as getting things in. So it's a real combo.
Yeah, I think for us, the kind of highest quality is coming from our existing portfolio company CEOs and founders. I find that they often have the highest bar before they show something to you, versus sometimes prior investors can be a little bit biased if they're trying to just kind of pass off an existing portfolio company to the next round. I find people that have skin in the game both ways, it tends to be pretty high quality.
Was that a shot at Andrew right there? That
He's always been
Never.
Yeah, same here. Our existing portfolio of companies are always sending us really good referrals. Also, I think our sweet spot is making sure we stay friendly with all the early stage funds. If it's a click too early for them, it's probably perfect for us. And so a lot of our better companies come through referrals from our mentors, which are the drives and the Ys and KB and courtside and Accomplice and sports-centric funds like that.
I'd also add, obviously in our space, one of the reasons why like the athletes and the teams and the trainers and others, we think of that as our strategic base. And we get a lot of input from that of what are they using, what is at the tip of the spear, sort of at the most elite level. And we oftentimes look at the space as, sports as a wedge to a broader market. There's a lot of people who are highly influenced, who think like if it's good for them, I know it's going to be good for me or great for me, even if I use a fraction of the capacity of whatever that is.
Awesome. So I think we're just about out of time unless somebody has a burning question that they have to ask, and since I don't think they do, I'm going to say thanks to our panelists for an awesome presentation. Thank you all.